So let's start with a merchandising business. Well, when we talk about merchandisers, we're essentially talking about any type of retail or wholesale business. It's essentially anyone that buys a finished good from another company, like a manufacturer, and then resells it to someone else. So their basic cash cycle is going to be they use cash to purchase merchandise. They then sell that merchandise to a customer. They may sell on cash or they may sell on credit. Most businesses sell on credit. If they sell on credit, they then in turn have to collect on their receivables in order to convert that back to cash. Now, here's an example of a chart of accounts for a merchandising business. Now, this is just an example. As we've talked about in prior weeks, the chart of accounts is going to differ for each company. And what you'll find in your assignments is they will typically give you a chart of accounts to use, or you can assume that we're using fairly standard account names such as accounts receivable, merchandise inventory, cash. Those are accounts that any company would have. But we can see some additional items here that we might not see for just, say, a service business. We're going to see inventory, we're going to see cost of goods sold, and we may see some other accounts as well. So let's take a look at what happens when we sell merchandise, okay? Now, in this example, we're assuming that we sell in exchange for cash. But I can tell you that the basic process is pretty much going to be the same regardless of whether we sell for cash or whether it is an accounts receivable, okay? We're always going to have two pieces to the journal entry. The first piece is to record the asset, that's going to be the cash or the receivable, and also the sales revenue. And then the second entry is going to record the cost associated with what we sold, and it's also going to relieve the inventory account on the balance sheet, okay? So in this example, we're assuming that a company sells merchandise for $1,800, okay? So $1,800 is the selling price. The selling price is what's always used to book the sales, okay? So here we have a debit to cash and a credit to sales for $1,800. If this had been a credit sale rather than a cash sale, we would have a debit to accounts receivable and a credit to sales. So the only thing that would be different is instead of the debit going to cash, the debit would go to accounts receivable. But again, it's always going to be in this basic format, and it's always for the selling price. Now, in contrast, when we record the second entry, that is based on cost. That is, what did it cost us to buy the merchandise, okay? So we are going to debit cost of merchandise sold, or commonly called cost of goods sold. Either one is fine. We're going to debit cost of goods sold for $1,200, and we're going to credit merchandise inventory for $1,200. This increases the expense and decreases the inventory account. Now, you may initially think for a second, well, you know, why is one entry for one amount and the other entry for the other amount? Okay, let's think about it. The difference between the two is essentially the gross profit. Okay, for example, let's say that you go into Walmart. They're a classic example of a merchandiser. You go into Walmart and you buy something for $20. Well, you can take it to the bank that Walmart didn't pay $20 for it. You know, Walmart might have paid $7 or $10 or whatever the case may be for it. So the difference between what the merchandiser sells it for and what they actually paid for it, that difference will eventually represent gross margin or gross profit. But essentially, we always record the sales piece based on the selling price. We always record the cost piece based on our cost. That is what it cost the company originally to buy the merchandise. All right, now you're also going to learn about a couple of different shipping terms. And shipping terms really become important at the end of the year when we are trying to determine who owns a particular batch of goods. Okay, so we may have we may have trucks out on the highway delivering stuff. We may have barges out on the ocean delivering stuff, stuff on planes, whatever. When stuff is in transit, and that's what we normally call it, when it's in between the buyer and the seller, we need to determine who has ownership of it. All right, so we've got two basic choices here. We've got what's called FOB shipping point and FOB destination. FOB stands for free on board, okay? If something is shipped, FOB shipping point, then what this means is as soon as the merchandise leaves the shipping point, the title immediately passes to the buyer, okay? So as soon as this truck pulls away from the seller's loading dock, the buyer owns that inventory, okay? And when it's shipped free on board shipping point, typically the buyer pays for the freight, okay? In contrast, we have FOB destination. This means that the title does not pass to the buyer until the goods actually arrive at the buyer's location, okay? And if it's shipped FOB destination, then it is the seller rather than the buyer who pays the freight cost. Okay. This week, we also learn how to prepare a multiple step income statement. Essentially, we have two types of income statements. We have a single step and a multiple step. The single step approach puts total revenues together, total expenses together, and says total revenues minus total expenses equals net income. The multiple step method essentially just breaks it down into additional categories. It gives us additional subtotals that we would not see using the single step approach. Now, one important thing to note is you're going to get the same net income regardless of the approach that you use. The multiple step is just a bit more detailed. Okay, for example, when we're using a multiple step approach, we will take sales minus cost of goods sold to arrive at gross profit. Sometimes this is also called gross margin. Okay. Once we have gross profit or gross margin, we will then deduct all of our operating expenses. This allows us to get a subtotal of income from operations, okay? And then we can deduct our non-operating expenses, or if there's any revenue, add that back, taxes, that type of thing. But what this does is it gives us some subtotals that can be useful from a financial statement analysis perspective, which we're going to learn a little bit more about later on in the course. Okay. Now, as you might expect for a merchandising company, inventories represent a substantial use of our assets, substantial use of financial resources. For that reason, we want to make sure that we have some controls in place over inventory. One of the key objectives is to safeguard the inventory, that is to protect it from theft, damage, spoilage, obsolescence, whatever the case may be. And then the other objective is to make sure that we are appropriately reporting inventory in the financial statements, okay? Remember that when we first buy inventory, it is recorded as an asset on the balance sheet. Once we sell it, it moves to an expense on the income statement. So ensuring that inventory is being appropriately reported is going to ensure that we are properly reporting revenues, expenses, income, and even our current assets appropriately for a given accounting period.